Many people think that investing is something for millionaires or those who understand economics. None of that. The truth is that anyone can start investing and become rich, and it is precisely those who understand the right strategies who get ahead. Wizard, the financial market is not a seven-headed beast. It is a tool that can transform the way you see and use money. The difference between those who thrive and those who stagnate lies in understanding the basics and putting them into practice. Today you will learn from scratch, without complications, how to make your money work for you and, who knows, achieve that extra income that seemed like a distant dream. We will demystify what no one tells you about investing and make your financial freedom a reality. For those entering the world of financial education now, understanding basic concepts is like taking the first step toward a more peaceful life and, of course, who knows, more wealth. Starting with fixed income and variable income. While the former promises a more predictable return, like Treasury Direct, the latter exposes us to ups and downs that, although they may be frightening, offer greater profit possibilities, as happens when investing in shares of technology or consumer companies. Knowing how to distinguish between these options already helps to give direction to your financial planning. Another key concept is interest rates, which may seem like a common expression, but directly impacts the money in our pockets. Just imagine, an increase in interest rates makes credit more expensive, affecting everything from car financing to credit card installment amounts. Understanding how interest rates influence the economy helps predict the right moment to invest or even to postpone a purchase. And, speaking of influences in the economy, we cannot overlook monetary policy. Often it is seen as something distant, but in practice, it is present in our daily lives. It is the central banks that determine these policies, and believe me, they impact everything, including our ability to save and invest. If interest rates rise, it may be advantageous to leave money in fixed income investments. If they fall, it might be worth paying more attention to variable income. The interesting thing about understanding all these terms and how they interconnect is that, little by little, we realize that financial control is not just about salary or how much we save, but about knowing when to choose each investment moment. After all, each of these decisions can open pathways to extra income or, who knows, accelerate a plan to accumulate wealth for the future. This knowledge is like building a foundation, and that's what we want. Understanding these initial points well is essential to take the next step safely and, with each new decision, be closer to achieving not only financial independence but also the real possibility of transforming the way we see and manage money. Central banks may be one of the main engines that drive or slow down a country's economy. It is based on their decisions that interest rates are adjusted, and each movement in this rate can influence everything from the value of our money to the prices of products on the shelves. Imagine that if the central bank decides to raise interest rates, credit becomes more expensive, which reduces consumption and, in a way, helps control inflation. This process directly impacts our financial planning, making us rethink even that old habit of splitting a purchase into installments. When it comes to inflation, the interest rate policy of central banks becomes even more crucial. If prices skyrocket, the most common strategy is to raise interest rates to slow down consumption. This may seem technical, but in practice, it affects our lives in things as simple as the increase in the value of the grocery bill. And more. If inflation is high, our purchasing power decreases, meaning that money loses value. Learning to observe these movements helps decide when to save and when to spend, which is essential to protect our wealth. Another important point is that central banks do not operate in isolation. On the contrary, their decisions can influence other economies, leading us to consider even global movements. For example, a rise in interest rates in the United States can attract investments from other countries, such as Brazil, because people seek safety in a strong currency. This capital flight scenario directly impacts investors, showing that money tends to migrate to where it finds greater stability and return. For those who want to build wealth and think about earning extra income through investments, understanding the role of central banks helps see opportunities and risks in the financial market. When interest rates are low, there is more incentive to invest in variable income, seeking better returns. If interest rates rise, as in the case of some government bonds, they become more attractive because they offer safety and return. Knowing how the central bank manipulates these indices can, then, be the secret to identifying the best moment to move your capital. With all this, what can be perceived is that the world of finance is not static, and the decisions of central banks act as true levers that regulate the value of money around the world. Perceiving these signals and adjusting personal financial planning can be an excellent way to stay ahead and prepared for when the next opportunity arises or, who knows, the chance to multiply the value of your investments. Inflation is one of those phenomena that everyone feels, even if they don't exactly know how it works. Basically, it is when money gradually loses value over time. A simple example: imagine that 5 years ago, with a certain amount, you could buy more things at the market than you can today. This shrinking of purchasing power is inflation, and it occurs because the prices of products rise while the money we have in our pockets seems to decrease. For those who want to protect their wealth, understanding this process is fundamental to making good financial choices. Now, alongside inflation comes the issue of devaluation, which is the loss of value of a currency in relation to others. Let's suppose the dollar rises against the real. This means that to buy $1, you need to spend more reais. This effect may seem distant, but it directly affects the price of imported products, international travel, and even the cost of some foods. Devaluation influences not only the money we spend, but also what we invest, as investments in strong currencies can be a way to protect oneself. For those who are financially planning, inflation and devaluation work almost like invisible enemies. They erode our money, and therefore having a strategy to maintain the value of assets is essential. Investments in assets that tend to keep pace with inflation, such as government bonds, can help protect capital value. Likewise, investing in strong currencies, such as the dollar, can be a way to balance the losses that come with the devaluation of the local currency. Thus, with some well-thought-out choices, it is possible to minimize the impact of these effects on our wallets. Furthermore, understanding how inflation works allows one to predict moments when the financial market may present good opportunities. For example, during periods of high inflation, it is common for interest rates to rise, as mentioned before. This makes fixed-income investments more interesting for those seeking extra income or looking for a way to protect their money. This strategy helps avoid losses and even grow financially, even in challenging times. Finally, dealing with inflation and devaluation doesn't have to be a seven-headed monster. This basic knowledge allows you to adjust the direction of financial planning toward a safer and, why not, more profitable path. By perceiving these economic tides, investors learn to navigate with more confidence, seizing opportunities for appreciation while sidestepping the traps that diminish the purchasing power of their money. When it comes to investing, one of the first distinctions we need to make is between fixed income and variable income. Fixed income offers a more predictable return with lower risk, such as U.S. government bonds, which work as a kind of loan to the government in exchange for interest. For example, by investing in a U.S. Treasury bond, you know that the return will be more stable, which greatly helps in financial planning and even in creating an emergency fund. This type of investment is recommended for those seeking safety, even if the return is not that high. On the other hand, variable income involves assets like stocks, which are subject to market fluctuations. Investing in stocks is like becoming a partner in a company, and of course, the greater the profit expectation, the higher the risk involved. Shares of technology companies like Apple or Amazon are examples of investments that can offer an interesting return but require careful attention, as prices can rise and fall quickly. For those looking for extra income and wanting to take advantage of growth opportunities in companies, variable income can be an interesting choice. The secret to choosing between fixed income and variable income is to understand your goals and your profile as an investor well. If you have a higher risk tolerance and want to see your wealth grow more quickly, variable income may be a bet. But for those who prefer safety, fixed income is more suitable. This balance allows the investor to take advantage of the benefits of both types of investments, building a portfolio that mixes the solidity of fixed income with the profit potential of variable income. When deciding where to invest your money, it's important to remember that there are risks in any choice, but they can be minimized with planning. For example, one strategy is to split investments between fixed and variable income, protecting a portion of the money in safer assets while seeking a higher return with the remainder. This type of diversification not only helps protect your wealth but can also provide a sense of security and financial control. Thus, understanding the different types of investments is fundamental to making money work in our favor. Each choice made in the world of investments is a building block for wealth and financial security in the future. By exploring and learning more about these possibilities, the financial journey becomes an efficient tool, always aligned with our goals and needs. When we talk about long-term investments, market indices and index funds are excellent for those looking to build wealth intelligently. The S&P 500, for example, is an index that tracks the 500 largest companies in the United States, such as Google, Microsoft, and Coca-Cola. Investing in a fund that replicates the S&P 500 allows the investor to access a diversified group of large companies, reducing risk by not relying on just one or two stocks. It is a strategy that, even with fluctuations, has historically shown good results. Index funds are a great alternative for those who want to invest without needing to choose each stock individually. It's like buying a basket of companies instead of betting on just one. This makes life easier for beginners who may not yet have much knowledge of the market, as it allows for diversification without complications. Additionally, many index funds charge low fees, which is an advantage for those looking to maximize profits over time. After all, every penny saved in fees is an extra penny in your pocket. Diversification is one of the best ways to protect your money, especially when we talk about variable income. By investing in a fund that tracks the S&P 500, the investor is, in practice, benefiting from the growth of several companies at the same time. This means that even if one company faces difficulties, others can compensate, keeping the investment performance more balanced. It is an efficient way to protect against market fluctuations since indices tend to follow the overall performance of the economy. Another point in favor of index funds is that they require less time and energy from the investor. Unlike trading, where one must constantly monitor the market, an index fund allows the money to work on its own, following the movement of the main companies in the market. It is the type of investment that facilitates long-term financial planning, as the investor can focus on other areas while the fund automatically tracks the market. Thus, understanding the role of indices and index funds is essential for those who want to invest practically and efficiently. This knowledge opens doors to a safer type of investment, ideal for beginners or those who prefer to avoid excessive risk. And, of course, this strategy is an excellent foundation for any portfolio, providing a blend of stability and growth potential over time. Investing in the stock market is one of the most well-known ways to make money work. But what many people don't know is that the options within this market are quite varied. Stocks, for example, are a popular form of investment, where you buy a slice of a company, participating in its profits and losses. If a company grows, its stocks tend to appreciate. But, of course, the opposite is also true. Therefore, investing in stocks requires good financial planning and, mainly, an assessment of the risks you are willing to take. This is an interesting option for those who want to diversify and seek potentially higher returns. Besides stocks, another segment in the stock market that attracts investors is commodities, such as gold, oil, and soybeans. These assets are widely used as protection against inflation since they tend to maintain their value even in economic crises. Gold, for example, is seen as a safe haven in times of uncertainty, as its value tends to rise when stocks fall. This type of investment can be a way to balance the portfolio, protecting against more aggressive fluctuations in other assets. Investing in currencies or foreign exchange is another possibility that brings unique risks and opportunities. The exchange rate of the dollar, for example, can vary significantly due to global factors, such as decisions made by central banks or international crises. If you think the dollar will appreciate against the real, you can invest in assets that track this currency. But be careful. The foreign exchange market is known for its volatility, which requires a lot of caution and a good dose of knowledge. For those who are starting, it's advisable to study well before entering this type of investment. Each of these options in the stock market has a risk profile and requires a specific level of knowledge. Diversifying between stocks, commodities, and currencies can help reduce risks, as each asset reacts differently to economic events. This allows a diversified portfolio to better withstand market fluctuations, ensuring more security for the investor. After all, putting all your eggs in one basket is always riskier. Understanding the various possibilities within the stock market and knowing how to combine them is an important step for those who want to build wealth and increase the value of their extra income over time. Learning about these assets is like uncovering a range of opportunities, And the more you know, the better prepared you are to deal with market twists and turns and seize good moments to invest securely. The difference between investing and trading may seem subtle to those starting out, but in practice, it is quite significant. Passive investing means betting on long-term growth by acquiring assets such as stocks, funds, or bonds that tend to appreciate over time. It's like planting a tree. You water it, care for it, and let it grow gradually. This strategy requires patience, but on the other hand, it allows the investor to focus on other aspects of their life while their money grows. It is the ideal choice for those who prefer to avoid the stress of daily market fluctuations. Trading, on the other hand, is an active approach where the goal is to take advantage of daily price variations to profit from market swings. Traders buy and sell frequently, monitoring charts and news to make quick decisions. While the profit potential is greater, the risk also increases, as traders can lose money in a matter of minutes. This type of strategy requires not only technical skill but also well-honed emotional management, as the market can be unforgiving of impulsive decisions. For those seeking stability and secure wealth growth, passive investing tends to be the better choice. It is possible to invest in index funds like the S&P 500 that we mentioned, or in ETFs that replicate the performance of several stocks simultaneously. This way, the investor can build a diversified portfolio without needing to dedicate hours to monitoring the market. This type of investment is usually more predictable and less stressful, ideal for those seeking extra income without the constant pressure of tracking prices. On the other hand, those interested in trading should be prepared to learn, as success depends on technique and a lot of practice. Successful traders study market trends and develop a consistent strategy, as well as knowing how to manage their own emotions. For example, it is common for a novice trader to try to recoup losses impulsively after losing money, which usually leads to more losses. Discipline and calmness are essential for anyone choosing the trading path. Knowing how to differentiate these approaches is crucial for those who want to invest intelligently. Each one requires a certain type of preparation, and understanding your financial objectives helps choose the strategy that best fits your profile. With time and the right knowledge, both passive investing and trading can be great allies in building wealth, as long as each is used according to personal goals and the time the investor wishes to dedicate to them. Taking control of your financial life is more than just numbers or spreadsheets. It's the key to a life with more choices and fewer worries. Imagine living peacefully, knowing that your money is working for you. This is not a privilege for the few. It is an opportunity within reach of anyone dedicated to understanding and applying what they have learned today. Wizard. And to help you even more in this process, I have left a tool in the pinned comment that can be the key to organizing your finances once and for all. With it, you will have a clear view of your expenses, be able to plan your savings, and start investing intelligently. Don't let this opportunity pass by. A small investment now could be the step you needed for your great leap towards financial freedom. So, subscribe to the channel and activate notifications to continue this journey of learning and transformation. After all, every step counts, and together we can achieve results you never imagined were possible. The next level of your financial life starts now.